That's bad. That's bad, actually. But welcome to Options Brew TV. Guess who we got back on today? My buddy Matt Cashman. Hi, Matt. How are you?
I'm doing well. I love the intro music, Lex. It's
amazing.
Yeah.
I gotta have a little thumpy, man. I like thumping. And check out the shirt. Peace out, brother.
I love it. Peace
Yeah,
out.
I'm in my very casual mode today. But we're gonna get to some good not heavy stuff. I don't want to say heavy, but good stuff, some deep stuff. So Matt, tell the gang where you're from. We have a very similar background. You're at the OIC. Tell them a little bit about that real quick, just a brief intro, and then we're gonna get right into the topic, which is gonna be dividends today.
Oh yeah. Yeah. Dividends, what everybody wants to know about.
That's right.
My name is Matt Cashman. I have been an options trader for about 20 years. I got my start in 1999 on the floor of the CBOE around the same time that Lex started trading there. We didn't really know each other back then, but we do now. And I moved to London in like 2002, 2000, from 02 to 06 or 07. I've traded kind of a little bit of everything, always option based. I've always traded optionality, whether it be equity options, index options, or in London, for instance, I traded Boon, Bobble, and Shots, the long end of the German interest rate curve out there. I traded options on that. Then I moved back to the United States and started an index market making firm, again on the floor of the CBOE, and ran that firm for about 10 years, about the better part of a decade, and wound that down in about 2015. But since then, I have had a couple of different incarnations, but currently I work for the OIC, which is the Options Industry Council, and the OCC, the Options Clearing Corporation. Options Clearing Corporation is the largest clearing corporation of its kind in the United States. If you trade index or equity options in the United States equity market, the OCC touches that option somewhere along the line. Now, OIC is the educational arm within the OCC. We are a non-for-profit corporation that is inside the OCC, fully funded by the OCC. And our job is basically to create educational content and teach people about options, teach people about the risks and the benefits of exchange traded options, centrally cleared options. And that's what I've been doing for the better part of about a year for them. And so that's why I'm here. We talk about options.
I love it. I love it. And we at Tradier love education. We pride ourselves on having a client base that is pretty well informed about options. And when Matt and I met, I think it was at some event in Chicago, or maybe it was in Vegas, I forget.
We met in Las Vegas.
Yeah. So we started talking, and I said, wow, what a great combination here. We can do a little education piece frequently. So I think, my game plan, Matt, is to do more of these, maybe shorter segments, and get ourselves a little OIC/Tradier, catalog together.
Collaboration. I like it. Yeah.
So this is great. So you talked about, we're going to talk about dividends, and here's the deal from my perspective. I'm going to let you explain it all. In the professional world where we come from, we understood dividends. We understood the risks of dividends. It was very much a thing you had to know to trade options, right? Especially equity options. Maybe indices were a little different and a little more muted, but equity options, which is where I grew up, was it an important topic to understand. Having said that, what I find on the retail side, and I deal with a lot of retail traders and investors, it's probably a lot less understood, especially the inherent risk of early exercise. Yeah. So people get a little confused on that. So maybe we can touch on some things there, but it's an important concept to know. I think you're going to give us an overview of all of it and what it all means. So let's have at it.
Yeah, right on. Let's talk a little bit about just dividends in general, right? For the uninitiated to dividends, obviously, it's essentially just a distribution of profits by a corporation to its shareholders. Now, that can take many different forms, right? Most of the time, corporations pay cash dividends. That's the most common of those dividends. Mm-hmm. Now, when a corporation earns a profit or has surplus profit and it wants to pay out to its shareholders, this is usually how they do it. It can be in cash, it can be in stock, it can be in other kinds of assets as well. Now, as far as the history of the dividend is concerned, The first dividend to be paid was 1602 or something, right? The Dutch East India Corporation, which a lot of people think of as the first multinational corporation, the first corporation to issue stock publicly. They paid a dividend from 1602 to 1800, almost 200 full years. And if you look back at the history of it, annualized, it was about 18% of the full value of the stock. So that's an incredible run, right? First of all, like most of the, if you were to think about that in the kind of reference it to the modern history of it, we don't have situations like that anymore.
Right.
But like I said, so that's obviously a really good track record for them. But currently, right, the most common form of payment is a cash div. And there's also stock, or what are referred to as scrip divs. Those are paid out in the form of additional shares of the issuing corporation, or in the case of someone wanting to maybe spin off something else, they'll pay it out in shares of another corporation that they're spinning off. They're usually issued in proportion to the shares you own. So if you own 100 shares of stock and a company declares a 5% stock dividend, they're going to give you 5 extra shares of stock for your 100 shares of stock, right? Now, different classes of stock also have different priorities. When you're talking about distribution of profits from a corporation, preferred stocks have priority claims on a company's income. So a company has to pay dividends to its preferred shares first before it pays to the common shareholder. Now, that's generally speaking, it's not something that people get too wrapped up in, because if you're a common shareholder, you probably know you're getting the div anyway, and it's not that big of a deal, right?
Right.
But there are, so that's kind of the history of where the dividend came from and where we are now as far as kind of how it gets paid out. So the other thing that I think people really want to know about, and it's really important to know about from a stock trading standpoint, or options on the stock trading standpoint, are all these terms that we have, right? They can be kind of confusing as far as dividend terminology is concerned. The first one, kind of in order, is the declaration date. It's the day the board of directors announces its intention to pay a dividend. Now, a company announces it's going to pay it. The actual, all of the components of the dividend are actually decided by the corporation. We actually talked about this on the investor education desk today. And the exchanges and the DTCC and the OCC and all of these, like regulatory bodies don't have anything to say about all of the different parts of that dividend. So the X date, the record date, the declaration date, all of those things are decided on by the board of directors of the company that's paying it. Now, they announce their intention to pay a dividend on the declaration date. The next date you really need to worry about is what's called the ex-div date, or the ex-dividend date. That day is the day on which shares bought and sold no longer come attached with the right to be paid the most recent dividend. That's why it's called the ex-div date. It means it doesn't have the dividend in it.
So you have to own, let me interrupt, Matt. So you have to own shares the day before that X date. Is that correct? Or day before or earlier?
That is correct. And the day before the X date is generally referred to as the record date. Now, as far as the X date is concerned, we'll get to the record date in just a second. As far as the X date is concerned, existing shareholders will receive the dividend even if they sell the shares on or after that date. Okay. Whereas anyone who bought the shares will not receive the dividend on the X date. That's why it's called the X date. It does not have the dividend in it. Okay.
Perfect.
Now, the day before that is generally called the record date. The record date is referred to as that because it's the day that basically the company closes their books and they look at their ledger of shareholders and they take a picture of it, more or less, virtually, and they say, these are the shareholders of record on this date. These people are getting the dividend. So when we talked about the X date and you said you need to own it the day before the X date, that is true. You need to own it on the record date. You want to be a shareholder of record on that date so that when they take a picture of their books, you're on the list.
Okay.
And then the last date is the payment date, right? The day on
Okay.
which the dividend checks will actually be mailed, or those electronic transfers, those ETFs will actually come into your account, and everything will be credited into the shareholders of record.
Okay. When does that usually happen? Is there a systematic time frame that dividends are paid out, or is it just kind of particular to the company?
It varies from company to company. It's not anything. It's a kind of like a case by case situation. I hesitate to ever give like guardrails as far as those dates are concerned, because they can be kind of different depending on how those companies want to pay out. A lot of companies, right, they need to manage their cash flow.
Yep.
Right. There's a decent amount of cash flow that's happening as far as, especially public companies, they're going to pay. If your dividend gets to a point where it's like, if you're paying dollars worth of dividend and you have, a float of, there's 20 million shares out there, there's a lot of money going around, right, going out the door. So they need to manage their cash flow and make sure that they know when they're paying it and have control over that. So,
okay. Got it. All right.
Yeah.
So having said that, now, how does this all weave into the whole options world? Now, we don't have time today to get into my horror stories about dividends being erased or increased and special dividend. But guys, I have a lot of stories about that. We were the DPM, remember? And we found a way to really get killed on some of these things.
Somehow every time we were on the wrong end of the stick.
Never on the correct side of it. I can tell you that right now. We'll get to that in another episode. But let's talk a little bit about how this affects the world of trading options, because it is profound, right?
Yes, absolutely. Okay. And especially in equity options, right? The vast majority of equity options, unless you're dealing with a really interesting like flex or something like that, they're always American style options, right? And American style options have within them the ability to exercise that option. If you're the holder of the option, you can exercise that option anytime you want up until the actual expiration date, right? Which is different than European options. If you want to trade something that doesn't have any early exercise risk, as far as, a dividend or anything else, you should probably be trading European options, right? European options only expire on that, or they only exercise on their expiration date.
Right.
American style options, which are generally equity options, you incur the actual liability, especially if you're short them, that you could be exercised at any point in time.
Right.
Now, what does that mean for equity option prices with regard to dividends? The hard part about American style options is that Black-Scholes, the formula that creates these option valuations, doesn't really deal with dividends very well. Right? We decided as option traders to kind of like manually put in the dividend amount.
Right.
And that was kind of a way that we figured out how to kind of like backdoor the modeling for the dividend, right? But it's not like Black-Scholes has this like column on it that says like, what's the dividend?
Yeah.
Black-Scholes is strike price, risk-free rate, right? The price of the underlying and the implied volatility and the days to expiration. That's really that's it. There's no dividend column here. So we had to kind of backdoor it. Now, from an options valuation perspective, and specifically, let's talk about early exercise. Let's say you're short an in the money call and you're coming up on ex-div and you want to kind of figure out whether or not you have a high probability of being exercised on your call, or being assigned on your call. If someone exercising that call and you being assigned, you're short it.
Yep.
What you really need to do is figure out, if you're short that call, think about it from the other side of the coin. If you were long it and the dividend was, say, 50 cents.
Yep.
In order to get the dividend, you have to be a shareholder of record, not a call holder, right? Option holders don't get paid dividends. Stockholders do. And so in order to receive the dividend, you have to be a stockholder and not an option holder. So if you're long that call, you have to exercise that call in order to convert it to an underlying position before the record date in order to get the dividend. Well, how do I figure out if I'm short that call, whether or not I have a high probability of being assigned? Well, there's a good way to do it. And how did you do it when you were trading?
Well, we knew the mathematics of it. So we had a formula for the cost of carry of the stock once you exercise it prior to ex-dividend.
Yep.
Till the term of expiration for the option in question. So it was 10 days, 12 days, whatever. So we had to carry that stock for that length of time. But in order to make what we called a synthetic call out of it, we had to buy the corresponding put. So we had a dividend amount and we had to pay for a corresponding put. So the dividend were higher than that corresponding put plus the carry. The call was an exercise, right?
Yes.
So that's how we looked at it.
Yes. And that's how most market makers look at it.
That's right.
Because, and the reason why you look at it from a market making perspective is because you have, 73 strikes, 25 of which are in the money, and you have actual inventory on those, either those calls or those puts or whatever they are. And so you need to know at some point, right? It becomes, and I used to look at it, you would look at the in the money strikes and you'd have a percentage probability of early exercise, right? It'd be 100%, 100%, 100%, 100%. And then you'd get to the ones that were a little bit closer where the puts were worth a little bit more and your percentage would go down. Once you get to the at the money options, then it's like no one knows whether or not you're going to get exercised on.
Right.
But the great rule of thumb and the way that people generally think about it is they do what you just did, but in shorthand form. A lot of times people don't think about the cost of carry.
Yep.
And that is something that you should build in, but not always, not everybody looks at it that way. Most of the time, what people do is they just look at the price of the put, of the corresponding put that they're short that in the money call. If you're short the 20 call and the stock's trading 30, and you want to know what your probability of really being exercised is, well, go look at the 20 put and look at the value of the 20 put. What that's going to tell you is how much premium the market is willing to assign to the value of that out of the money option. And thus that'll give you an idea for how much time premium is left outside of the intrinsic premium, the parity that's in your call. And then you need to compare that number to what the dividend is.
There you go.
Because if you are long that call and you can exercise that call, get the dividend, and the dividend that you're going to get is more than the value of that put, you are more than likely going to be exercising that call.
Right.
And so you need to think about it in those terms, because if you're short the call, you need to be thinking about the person who's long it and whether or not they're going to exercise, and thus let that inform your idea of how likely you are to be assigned.
Right.
Right.
Okay. Perfect.
Let's talk about American versus European exercise. There's two different concepts here, right? So Matt, why don't you explain that to us, what the difference is between those?
Yeah, absolutely. So there's two different kinds of options basically that trade in the United States that are really listed options, right? Within the over-the-counter space and the exotic space, there's a ton of different, there's, barrier options and all of these that have totally different risk profiles. But when you're talking about listed options, you're really talking about American style options, which are generally speaking, single stock equity options, right? So options on stocks like Apple and Google and Tesla and all of those things. And then you have what are called European style options. Those options generally exist on indexes, broad-based indexes that people utilize to get, a very broad-based risk exposure done with one very simple option. So options on the SPX, and the indexes that trade in the United States on the US equity market. And so the big difference especially as far as dividends and exercise and assignment are concerned between these two styles of options is that American style options, which again are those equity options, if you're trading equity options, you're probably trading American style options, can be exercised at any point in time during their life cycle up to and including the day of expiration. And so that's why the conversation that you and I had previously was all about early exercise. When you're talking about early exercise, you're talking intrinsically about an American style option. That's the only way you could have early exercise is with an American style option. Conversely, the European style options, which are, again, index options, generally speaking in the United States, can only be exercised on their expiration date, meaning they trade up until they expire, and then they all expire at the same time on expiration date at whatever time, generally 3:00 in Chicago, right? There's a print usually for equity indexes. And then also you have to consider most of the time, these index options are cash settled most of the time. And so what you're going to have is a difference between a cash settled option that doesn't have the ability to be early exercised and the American style option, which is on a single stock option, which is not cash settled. Those are generally, they have a deliverable, which is the underlying stock. So you have to deliver if you let's say you're short calls and someone exercises the calls, you actually get your stock, your physical stock called away from you. Someone wants your stock. And so you have to actually deliver the stock itself. So that's how that works as far as those two options are concerned. European style, only exercisable on the day of expiration at its expiration time. American style options include the ability to be exercised at any point up to and including their exercise date.
Right. Okay. And then from memory, was the OEX where I think you traded, was that an American or a European? I thought that could be exercised early. There's always that risk there in the OEX.
Yeah. OEX was actually one of those. OEX is a really interesting product. And I think, I'm not kidding, that it still exists today. It was one of the wildest pits I have ever been in my entire life. Because of just the amount of people that were in there. It was a massive pit. So there were probably 500 people in there when it was really trading, like rocking and rolling. And the crazy part about the OEX, first of all, it was a cash settled index, but it also, the OEX never had its own underlying. It never had its own future. So, and for those that don't understand it, the OEX is the top 100 largest stocks. It's an index meant to mirror the top 100 largest stocks, whereas the S&P 500 is the 500 largest. If you take the 100 largest, that's what the OEX is. It was meant for these like hyper big institutional clients to use that only wanted to trade this subsect of the 500 that was the 100 biggest stocks, right? It was the big blue chip names, the IBM and all of those names were in there. But it was early exercisable. And the crazy part about it was there was this time period where people started to realize that you could game that whole system.
Yep.
And they did it through the process of kind of examining where the open interest was and where the massive amounts of open interest were. And then because the OEX didn't have its own underlying, all of us that were OEX traders used to trade S&P 500 futures against our OEX 100 deltas that existed for options. So what that created was this entire spread that eventually had its own life called the 1-5. And it was called the 1-5 because you were trading S&P 100 deltas versus S&P 500 futures. And no one really wanted it that way. But we had to do it because that was our only real hedge against this product that traded in massive size and had incredible liquidity and just people moving options around all the time. And so we really wanted to trade the options. But the best hedge in the OEX back then was trading option versus option, because if you traded options versus the underlying, you were trading options in the 100 versus the 500 future. And so you had what we called 1-5 risk. Now, as far as early exercise is concerned, there was a period where people started to figure out that if you pushed the futures in the S&P just far enough along, it would trigger an early exercise situation if people were short a bunch of calls, because we, as market makers, didn't maintain the right to exercise our options. We were going to be assigned on these, and we constantly had to do the math to figure out how many of these that we were short we were going to be assigned on. Because if you're going to get assigned on those, you're losing all of those deltas that you have against all of these futures. So you have to either buy or sell futures against your position. And so people realize that if they push the S&P 500 futures just far enough, it would cause this break in the OEX options, and people would actually have to buy more futures. It was this self-fulfilling prophecy because the market makers would then have to chase it as they got exercised. There was a time period in the OEX, and I am not kidding, where there was a box, an actual box that was about this big that had a lock on it and a slot in the top of it. And when you were exercising your options, you would have to manually write them out and stuff them into the box before the bell rang.
Oh my God.
And so when people got to the point where the futures would tick and everything would, people would all make the decision at the same time, and it would always invariably be right before the bell would ring.
Right.
And so people would all jump over each other to stuff these exercise notices in the box, because they would stop you if the bell rang, because they considered it curb trading right afterwards.
Oh my God.
And it was, I mean, it was such a comedy of, it was just one of the craziest places I have ever traded. It was a lot of fun, and there were obviously a lot of great opportunities to make money, but you could also really get hurt badly in there if you got stuck one way or the other.
Well, you know what it brought the advent of is the basket trading, right? So our firm used to trade every one of the stocks in their proportion. Yeah. I don't remember what the weighting of the index was off the top of my head, but I had 100 stocks that we would be short.
Yeah.
And we would earn interest on that. And we'd have the combo on in the OEX.
Yeah.
And then you play those little shenanigans with exercises before the close, and you might get a good print.
Yes.
In which case you roll it out to the next month, and I'm like, oh my God, this became such an arb.
Yeah.
Crazy.
Well, those were the guys that were those traders were the people that were kind of keeping that in line most of the time, were the cash arb guys who had those massive positions on. The funny thing about basket trading, and it's changed a lot now because of the execution price being so low, but back then there was enough edge built into that trade where people still found it valuable to do the trade, but it was an expensive trade. You had to carry all of those stocks, right? Either long or short, and you had to carry, in the case of the 500, you had to carry 500 stock positions against an index position for just to maintain a delta neutral position. And a lot of people would kind of tailor their position. Sometimes they would, much like currency traders, when they trade, currency pairs, sometimes people will just be like, oh, well, yeah, that leaves me kind of short the krona, but I don't really need to buy back the krona, right? Like one of those things where it's like, we're not going to worry about that. And then all of a sudden the krona rallies 30% and everyone gets their faces ripped off. Well, this is one of those situations where people would kind of, you can tailor your position a little bit based on if you really are supposed to buy Coca-Cola stock to really balance your position, but you're like, I just rallied 5%. Maybe I should wait. There's a lot of that going on too. And it's, well,
those were the good old days. But that's a great explanation of the difference between American and European exercise. So we do get that question a lot. So I'm glad we talked about that. Let's cover one more little item here, and we'll wrap it. What happens to your call and put when the dividend is either increased or decreased? I know it's going to have an opposite effect depending on which way you go. Let's talk about a dividend set at $1. Let's just say, let's make the math easy. And we don't have to get the exact numbers. And all of a sudden, a news item comes out and says, "Hey, guess what? Instead of $1, we're going to pay $1.50." So they've raised the dividend unexpectedly. And again, we're not talking about any special dividends. We're not going over that in this. So I think I know what happens. Well, I actually do know what happens. But the only reason I say that is because if I have a conversion on, I know that's good for my conversion. If I own the stock, short the call, long the put, and they raise a dividend, everything's going well for me there. So my stock's good, my short call's good, and my long put's good. So I'm assuming that they go in the correct direction. So I'll let you take a stab. You go at it.
Yeah. So in that case, if we're talking about a dividend going up, you need to think about it in terms, and the way that I teach it is that you need to think about it in terms of, if you own the stock, what's happening to your position. So if you own the stock and you thought you were getting $1 of a dividend, you're actually getting $1.50 of dividend, right? But there's no free lunch in here, right? And so when dividends go up, generally call prices are going to decrease by that amount, and the put prices are going to go up by roughly that amount. Now, there's always an element of supply and demand in here, right? There's people constantly trading these options. And so I don't want anyone to think that they should be expecting those call prices to move by exactly the amount that the dividend changed by, right? There's always so much of what I teach about as far as options are concerned is that there's so many forces at work in the options world, right? And the dividend moving is just one of those forces that's moving things around. You also have to build into your idea about what's happening is what do other people have on? What's the, where are things going to generally trend to move? And then think about what are the forces that are at work here. But theoretically, if the dividend is going up from where it was expected, call prices are generally speaking going to decrease and put prices are going to increase because of the fact that people are thinking about that stock once it goes ex-dividend is now going to drop by, instead of $1 theoretically that they're going to be paying off of their balance sheet to their shareholders, they're thinking about, well, this thing is now going to drop by $1.50 on ex-dividend, and thus we have to adjust the combination, the combo, the call and the put values to reflect that scenario that we are expecting to happen on the ex-div date.
Right, exactly. So the other way they can think about it too is that call put parity has to have that $1.50 in it. Otherwise, all the really, really smart banks and market makers are going to arb the heck out of it.
Yeah.
So they can sell synthetic stock with that short call and long put way better than they can buy actual stock. They're going to do it forever and ever and ever, endlessly. And the options have to adjust accordingly to make that new price accurate. Otherwise, there's a huge arb there.
Yes,
right?
exactly.
And we know that won't exist, right? That's
right.
Really,
and that's what I was saying. Yeah, when I said that there's no such thing as a free lunch, right? That's where that is built in, is that you have to assume that much like, back when you were trading the basket and keeping the cash arb in line, right? Along with all of the other people trading it, all of those people that are out there making markets and trading, and especially in this electronic marketplace now where things move at the speed of light, basically, those people are going to keep that in line, because if it gets out of line by 3 pennies or 5 pennies or 10 cents or whatever, it instantaneously gets whacked by a computer somewhere where, right, the model has told people that, oh no, this is not in line anymore, and then a bunch of trades start to happen. So you need to keep that in mind when you're thinking about how those options are going to move relative to the dividend moving, right? Yep,
absolutely. Well, good. All right, Matt, that's awesome. That was a great segment. I'm sorry we had to break it up into 2, but we're going to make it work, right?
Yeah, right on.
All right, good. And we're going to see Matt on every once in a while on the Options Brew live show on Thursdays. So Traders Workshop. We got a good one coming up this Thursday, so we'll see you there for that one. And we're going to do more of these together too. So we're going to pick another topic like this and break it down. I really enjoyed this.
Awesome. Yeah. Thanks for having me. I really appreciate it. It was really good to talk to you.
You too, man. Talk soon.
All right. Later.
All right.